Hey traders, this is Mike Sir here. Welcome back to my channel. In this video, I'm going to talk about a trading instrument that I've been trading since 2005, and if properly used, can help you make a lot of money. Now, what I'm talking about is CFDs, or commonly referred to as contracts for difference. Now, I'm a huge fan of trading CFDs, so in this video, I'm going to share with you why you should consider trading CFDs, what are the benefits of trading CFDs, and what are the risks, and more importantly, how you can utilize this trading instrument to make a lot of money. Now, unfortunately for my American friends, you can't trade CFDs as they are banned in the US, but stick around to the end of the video and I'll explain why. So let's get started. First off, let me give you a brief history about CFDs. Now, they were originally developed in the 1990s in London, UK, as a type of equity swap that was traded on margin. Now, the invention of the CFD is widely credited to Brian Keelan and John Wood, both of UBS Warburg. And what CFDs are is they're contracts with a broker to exchange the difference in price between what you entered the trade in at and what you exit the trade at. So basically, it tracks the price performance of a trading instrument, which could be a stock, it could be an index like the S&P 500, or a commodity like oil, without actually physically owning the instrument or the asset. So for example, let's just say you bought a CFD contract of Apple stock. Now, you aren't a shareholder of Apple unless you actually physically own the shares in Apple. But what you do own is a contract that says you bought Apple stock at, let's just say, $200. And then let's just say a profit is determined upon the completion of that contract. So let's just say you sell the contract when Apple stock is now at $300, then you make a profit of $100. So why trade CFDs? Well, they're like derivative contracts, like futures or option contracts. So they serve two purposes for a trader. The first purpose is hedging risk. So they're used as a hedge to protect your existing portfolio against price movements. So let's just say you have a large stock portfolio and you fear that the market will crash. So instead of selling all your stocks, you buy a CFD contract that goes up in value when the market falls. So kind of like buying a put options contract. The other purpose is for speculation purposes. So similar to a futures contract, where it will help increase your exposure to price movements either up or down. So let's just say, for example, if you believe the oil price will go down, you can buy a CFD contract that goes up in value when the price of oil goes down. So you're probably now asking, well, what are the main benefits of trading CFDs? Well, the main reason why traders like myself trade CFDs is mainly because of the high leverage. It allows us to potentially make more money if our trade goes in our favor. So like all derivative contracts like futures or option contracts, it gives you the ability to put a minimal amount of capital to control a much bigger asset. Now, most CFDs offer leverage ranging from 5 to 1 all the way up to 200 to 1 leverage, depending on the type of asset that you're trading in the CFD. Now, you can check with your broker on what leverage that they offer for each type of CFD. Now, for Tradeview Markets, who is the sponsor of this video, they offer CFD trading with 20 times leverage for trading US stocks and 100 times leverage for trading US indices and commodities. As I mentioned in my previous videos, Tradeview Markets is an online trading platform that I personally use for trading the Forex market, US indices, commodities, and stocks. Now, they have an excellent reputation in the industry with 4-star reviews on Trustpilot and Forex Peace Army. Now, currently, they're offering a 15% deposit bonus for all subscribers of my channel. All you need to do is click on the special link in the description box below to open up a new account. So some of you may be asking, well, I'm trading futures and options already, and I get a lot of leverage from those trading instruments. So why should I trade CFDs? Well, let me do a side-by-side comparison. So let's compare trading CFDs versus trading option contracts. So the benefits of trading CFDs is there is no expiration date for CFDs. Whereas when you buy option contracts, there is an expiry date, and if the price doesn't reach your target price, then it could expire worthless. Also, there's no time decay in CFDs, whereas in option contracts, as you get closer to the expiration date, the value of the contract could drop significantly. The third benefit is there is no premium attached to your CFD contract, meaning that whatever the current price of an asset is, then that's what you pay. Whereas in option contracts, there is, meaning that even if you are right in terms of the direction of the trade, in order for you to make money on an options contract, you have to account for the premium that you paid for the contract. Now let's compare CFDs versus trading futures. So the benefit of trading CFDs is, as I mentioned earlier, there's no expiration date for CFDs, whereas when you buy futures contracts, there is an expiry date. The second benefit is with CFDs, you can buy as small as 1/100th of a contract, whereas with futures, the smallest micro-size contract that you can buy is 1/10 the value of an E-mini futures contracts. This means that it requires less capital investment per contract for CFDs. The third benefit is there are higher margins for overnight futures positions. So if you plan to swing trade or hold overnight your futures contract, then you have to maintain a much higher margin requirement, referred to as maintenance margin. So if you don't have enough capital in your account, then you could get a margin call in your futures account, and the broker will automatically close your position even if your position is profitable. With CFDs, there's no difference in margin requirements. So there's a lot of upside in trading CFDs versus options or futures, but there is some downsides. The first is interest. If you plan to hold any CFDs overnight or more than 1 day, then you'll be charged interest by the broker. This is because you're utilizing leverage or borrowing capital from the broker. The second limitation is higher spreads. If you're trading highly liquid futures contracts, your spread, meaning that the difference between the buy and sell price, is usually quite tight. For CFDs, which is trying to mirror the price of the underlying asset, the spreads can be wider, so you might be paying a little bit more when you buy and a little bit less when you sell. The last limitation for CFDs is that there are restrictions in certain countries. As I mentioned, trading CFDs is unfortunately banned for citizens from the US and are considered illegal in part because they are a leveraged product not passing through regulated exchanges. But this really means that CFDs could take business away from people trading futures and options, so it's obviously in their best interest to ban CFDs. Just check with your country's financial regulator to see if you can trade CFDs. As I said in my leverage video, trading CFDs is a double-edged sword, meaning that if you don't know how to trade CFDs properly, then you could lose a significant chunk of your capital, if not all of your capital. So let me show you a table of trading the S&P 500 contract with 100-to-1 leverage and how you could lose all your money. So let's just say you have a capital of $1,000 and you're trading the S&P 500, which is $4,000 per contract. So with 100 times leverage, you have actually a buying power of $100,000. So the maximum number of shares that you can buy is 25, which is 100,000 divided by 4,000. Now let's just say you have a stop loss, and actually here you can see it's at stop loss very, very tight. So even if you see that the S&P 500 contract just only go down 4 points or $4, 25 contracts times 4 would be equivalent to $1,000, which would be your entire capital. So you can see here that if you don't know what you're doing and you're utilizing maximum leverage, you could lose all your capital. So as I said in my leverage video, risk is always your number one priority. And when you're trading CFDs, start off with a smaller position first, rather than utilizing the maximum leverage that CFDs offer. For an example of how I utilize leverage trading CFDs, check out my leverage video on the left-hand side and the full playlist of my trading tools. I'll see you on the next video.